Meet James. James recently landed his first job as a business analyst and is now looking to start investing. While most of his friends have encouraged him, each one of them has a different idea about how to best invest his money. Robert, his best friend, advises him to keep it simple and invest in just two companies, Tesla and Apple. At the same time, his friend Leo insists that he should buy Bitcoin immediately. Already busy at his new job and overwhelmed with all these new terms, James has decided he wants to find the simplest way to get rich while investing. The answer he found is investing in index funds. Put simply, all an index fund is a basket of stocks that follows a benchmark index such as the S&P 500 index. In the case of the S&P 500, that index is a list of the 500 largest companies on the US stock market, bundled together into one single index. That way, if you were to buy one share of an S&P 500 ETF, you would be owning all 500 of those top US companies bundled up in a single share. The objective of an index fund is to earn the same return as the market index it is tracking. Index funds offer low costs, greater diversification, and extra convenience, making them a popular choice among investors. Okay, this sounds simple enough, but what makes passive index investing a better strategy than what my friends are suggesting? With a passive investment strategy, you don't have to spend all day learning about day trading and micromanaging your investment account, trying to time the market. With passive index investing, you minimize your buying and selling activity and maximize your returns by holding stocks and ETFs for the long term. Let's now have a look at some essential aspects of indexing. Feature number 1. One of the most attractive features of index funds and ETFs is their low expense ratio. Typically, with mutual funds and day traders, many expenses get passed down to investors, including commissions, taxes, and the fees of analysts who work at most wealth management firms. As indexing is a passive investment strategy, there is no need to time the market with frequent transactions. And because the index is automated, you don't need to pay the salary of analysts or wealth advisors, which decreases the cost it takes for you to invest. Typically, index funds have an expense ratio of about 0.25%, while actively managed funds tend to have expense ratios of 1 to 2.5%. So, if you were to invest $10,000 in an index fund with an expense ratio of 0.2%, you will need to pay $20 in expenses. But if you were to invest the same amount of money in an actively managed fund, you would need to pay $100 in fees to maintain that investment. Feature number 2. One feature that sets passive index investing apart from other strategies is that it grows exactly in line with the rest of the stock market. That's to say, if the S&P 500 goes up 10 to 20% in a year, you will earn exactly that, 10 to 20% in your investing account. On the other hand, actively managed funds and day traders can perform better in the short term, as managers are actively buying and selling stocks all the time. Index funds offer safer, more consistent returns with considerably less effort over the long run. This is because index funds are not trying to beat the market, and in theory, the market always wins. Studies also show that passive index funds and ETFs tend to beat day traders and active investors in returns. James also notices that it is essential to compare the returns with the risks involved. Index funds are simply an average of the stock market, meaning they have average risk. Active investing, on the other hand, means investors, like day traders, take on more risk in an attempt to beat the market. This exposes investors to serious risks if the market goes against their trades. Feature number 3. Index funds also offer greater diversity compared to other investments for a cheaper cost. This is because they track a whole index with hundreds, if not thousands, of stocks. Let's say James is investing in an index fund that tracks the S&P 500 index, while his friend Robert is investing in a single company, Apple. If Apple performs well, Robert will outperform James, as he will have a higher return from this single company. However, suppose Apple stock crashes, while other companies on the stock market do just fine. In that case, Robert will be affected a lot more than James, who owns a smaller proportion of Apple's stocks than Robert. This process is known as weighting, where each stock is assigned a particular weightage according to the market index the fund is tracking. Without index funds, it would take tens, if not hundreds of thousands of dollars to be diversified enough to lower your risk. For most people, that's not possible while buying individual stocks. Feature number 4. With passive index investing, you tend to buy and sell stocks a lot less frequently than other investors, meaning that you're not incurring capital gains all the time, raising your tax bill. If James owns an index fund, he will pay his capital gains only when he sells his ETFs, usually far off in the future, lowering his tax bill in the short term. Day traders, on the other hand, are buying and selling stocks all the time, often incurring expensive short-term capital gains taxes. Now that James understands how index funds work, he is excited to start investing right away. However, he is still confused about which index fund he should invest in. There are countless indexes and index funds for every single financial market in existence. He has asked his friend Noah to help him choose an index fund. Let's look at some of the most popular indexes and index funds. S&P 500 Index. Like we talked about before, the S&P 500 Index is an equity index that tracks the largest 500 companies in the US. For example, if you were to buy one share in this index, you would own companies like Amazon, Berkshire Hathaway, and JP Morgan, all heavy-hitting titans of the US economy. The S&P 500 Index is an attractive investment, as it has a historical annual return of 10% per year. Several index funds track this same index, such as Vanguard S&P 500 ETF and SPDR S&P 500 ETF Trust. The Vanguard S&P 500 ETF has an expense ratio of 0.03%, and it's one of the largest funds available in the market. If James invests $20,000 in this fund, he will have to pay only $6 in expenses. Russell 2000. Unlike the S&P 500 Index, which tracks large-cap stocks, the Russell 2000 consists of the smaller 2,000 companies in the Russell 3000 Index. The most common index fund that tracks Russell 2000 is iShares Russell 2000 ETF. The main advantage of this fund is that it offers exposure to numerous small-cap stocks, which can help with diversification. Smaller companies, like those in the Russell 2000 Index, also tend to have more growth potential than larger companies. The expense ratio of this fund is 0.19%, so if James invests $20,000, he will have to pay $38 as expenses. NASDAQ 100. The NASDAQ 100 includes stocks of the top 100 non-financial companies listed on the NASDAQ Stock Exchange. Invesco QQQ is the only index fund that tracks NASDAQ 100 and holds stocks mainly in the technology sector. This fund focuses on growth companies, hence increasing the chances of earning greater profits in the long term. For example, if you were to buy one share of the QQQ ETF, you would own companies like Apple, Microsoft, Amazon, Tesla, and Nvidia. In fact, because QQQ has more exposure to technology companies with high growth, it has outperformed the S&P 500 over the past few years. Some investors even argued that QQQ is the new S&P 500. This makes sense, because tech companies like Tesla, Nvidia, and Apple have a lot more growth potential than older companies like JP Morgan and Warren Buffett's Berkshire Hathaway. Invesco QQQ has an expense ratio of 0.2%, so if James invests $20,000, he will need to pay $40 in expenses. James is now familiar with different indexes and the ETFs that track them. He calls his friend Emma, a stockbroker by profession, to get an expert's opinion. Before deciding on an index fund, you should consider a few things. First, you should consider the location of an index fund. For example, the S&P 500 Index only consists of stocks in the US, so that can be risky if you don't have international investments. Second, you should also consider which stocks the fund holds. Some funds, such as Invesco QQQ, target tech giants, while others aim for mature industries like pharmaceuticals. Lastly, you should also consider the market opportunity the fund can present by reading reports about the industries your fund is targeting. For example, if your fund targets tech companies, you should ask yourself, are these companies innovating to become more valuable in the future? Thanks, Emma. Anything else I should keep in mind? You should also evaluate your investments in funds based on their expense ratios. Some funds can charge you a lot more as expenses, while providing the same set of services. More importantly, you should also check any minimum requirement while investing in index funds. If you invest via mutual funds, there is a minimum requirement of a few $1,000s. However, there is no minimum requirement to invest through exchange-traded funds, ETFs. Because of this, I suggest you invest through ETFs. Should I call my broker to start investing? If you buy an ETF, any investing app will allow you to trade them without any commission. However, suppose you opt for a mutual fund. In that case, you will need to look at the commission charges and other fees, which can reduce your money even before it's invested. It's better to start with an ETF rather than a mutual fund if you are a beginner investor. If you're also just like James and are confused about where to begin, consider using an investment app. Companies like M1 Finance allow you to buy and sell shares in stocks, bonds, and ETFs directly from your smartphone. Down in the description, we have an affiliate link to M1 Finance for beginner investors. When you sign up for M1 Finance using our link and deposit your first $100 to M1 Finance, you now get a $50 sign-up bonus. That's an instant 50% gain just for starting investing using M1 Finance. It also helps out the channel. Now watch this video about what happens to your money when you don't invest, and join us again as we make you a millionaire. Good luck investing!